Hello, I'm Laura McPhee, a reporter at Pensions Insight and Engaged Investor magazines, and I'm here with Nick Clay, a fund manager at Newton Investment Management. Very good to have you here today, Nick.
Thanks for having me.
Are you enjoying the conference so far?
It's a very good conference so far, yeah.
Good, glad to hear it. Well, today, like many pensions professionals, we're going to talk about risk. So, Nick, what do you think risk means today?
Interesting question, because risk has certainly changed over the last few years from what it used to be, and now the risk is one of actually losing money on a permanent basis. And in asset classes you would traditionally have thought were safe to invest in. Spanish bonds, Spanish banks, Greek bonds, even deposit accounts in Cyprus, for example, have been losing their money. And therefore, in a world in which central bankers, led by Bernanke, is forcing us to adopt risk to generate a return, he's made the risk-free rate of return negative on cash. So we're having to take on some kind of risk to generate a return. It's important that we understand what actual risk is nowadays. And it's not really just volatility, it's about permanent diminution in your capital. And that's what you need to avoid when investing your clients' money at the moment.
Absolutely. So, in these volatile times, what can pension schemes do to mitigate that risk?
So you have to think, what kind of investment return profile would you be looking for, and what kind of investment return profile would you be comfortable with? In a volatile world, you don't really want to have to go through that roller coaster ride. And a way of investing whereby your starting valuation is actually quite attractive at the moment is dividend equity income. They are actually got a positive real yield, which is very different from, say, many government bond markets out there at the moment. And it's also getting exposure to companies which have much better balance sheets than a lot of sovereigns out there at the moment, so you're not taking on the debt risk either. And if you can find the right companies that the dividend imposes the right discipline upon them in terms of capital allocation, you can get a consistent dividend over time which can grow, and that will end up being a very consistent generator of your total return over time. And in volatile low return worlds, that will make it up a sizable amount of your total return in the future.
Great. And where can you find that at the moment?
Well, luckily, on a global basis these days, it used to be the case that dividend stocks could only really be found in the mature markets of the UK, US and Europe. But now it's globally you can find these stocks everywhere. And in fact, the US is one of the lowest yielding markets in the world, and Asia is some of the highest yielding. And therefore, not only can you get exposure to good dividend income, but you can also don't have to sacrifice growth within your companies in order to get that yield. So you can capture both the dividend income growth and some capital growth as well.